Liquidity. What is the liquidity zone and what types exist? Liquidity is the technical zones on the graph. That is, liquidity is precisely in the understanding of how I will explain it now. Before that, you knew that liquidity is volumes for buying, selling in the glass, in the exchange, and so on and so on and so on. That is, each word can have different meanings depending on the context. In this case, in the context of the chart, we will call liquidity zones. These are some technical zones, that is, zones on the chart which are a magnet for the price that traders use as a goal for their positions. That is, we, as traders, will use liquidity zones as zones that must be removed, as zones that must be broken through. And accordingly, with the opening of the position in any of the sides, we should have some pool, that is, some liquidity zone that we aim at, that the price will come exactly there. Under liquidity, the following zones can be implied. These are maximums and minimums that are used to expose stop losses to retail traders and so on. That is, traders who trade technical analysis, patterns, two bottoms, head and shoulders, and so on. For a more detailed study, let's say liquidity from the point of view of retail traders, I recommend watching a free video lesson on my YouTube channel called, if I'm not mistaken, The Whole Truth About Technical Analysis. Also, under liquidity, extremums and levels can be implied, the breakthrough of which implies the continuation of the movement towards the breakthrough. That is, these are some levels. What are levels? For retail traders, this is one of the definitions of the level. This is some price area in which the price comes several times, tests some specific area, and for retail traders, it looks like a level of support or resistance. For us, smart money traders, it will be liquidity zones that will be broken through. And the next type of liquidity, technical, is the liquidity of the least resistance, and to be more precise, the absence of such liquidity and any resistance in some interval of the chart, and most likely the price will break it very impulsively. Let's go. The simplest types of liquidity are maximums and minimums, swing high and low, formed by trend. These are liquidity zones that can potentially be broken through. That is, if we have an ascending market structure, then each maximum is a liquidity zone for us, which most likely will be broken through, and our task is to open the position in the long when the price drops to the discount zone and close it above this maximum. And vice versa, when opening the position in the short, close it when reaching a certain level of liquidity. And the simplest technical liquidity zone is maximums and minimums formed by trend. With an ascending movement, each formed swing high will be a liquidity zone where professional traders plan to take a profit long position. With an ascending movement, each formed swing low will be a liquidity zone where professional traders plan to take a profit short position. Liquidity at maximums is called buy-side liquidity, or BSL. Liquidity at minimums is called sell-side liquidity, or SSL. Why is this maximum BSL called buy-side liquidity? Because when the price approaches these maximums, retail traders see this zone as a certain level from which the price has jumped down, and accordingly will plan their short positions from here. And accordingly, when the price approaches these maximums, retail traders see this zone as a certain level from which the price has jumped down, and accordingly will plan their short positions from here. We can open a graph of any cryptocurrency, for example TVT, pay attention to how we had an old maximum price, and after the price has broken it impulsively. You can look at Twitter, you can look at Telegram channels, how a lot of people entered after the breakthrough of this maximum. And as you can see now, after the breakthrough of this maximum, the price has gone below this maximum, and now it is also traded, if I'm not mistaken, below. The same thing here, sell-side liquidity. That is, when the price approaches here and when it drops up here, retail traders look at this zone as a support zone, and accordingly, when they approach this zone again, they will open their long positions. But when this zone breaks, they will have their stop losses, and accordingly, there will be an outflow of some liquidity for sale to the market, or sell-side liquidity. That is, the logic is clear. Equal highs, equal lows.
That is, this is a variety of BSL, SSL liquidity in the form of even maximums and minimums that form the level of support or resistance of retail traders. That is, when we have maximums formed in one area and each next maximum does not break the previous one. That is, some area is so dense, then accordingly this is an enhanced option, that is, the liquidity itself. Swing high, swing low. And accordingly, we understand that enhanced means that there is a high probability of removing this liquidity. The same is true here. We have some outflows in the price area in one zone, and the level of support that breaks through this liquidity is removed, and the price flies further up, removing buy-side liquidity. In fact, this constant ping-pong between SSL and BSL is practically visible on any asset at any time frame. Next, we will analyze such a tool as range. It is very interesting and very well used on the cryptocurrency market in the long-term positions and in the long-term investment. Before analyzing the liquidity of the least resistance, or to be more precise, the absence of such liquidity and any resistance in some interval of the chart, and most likely the price will break it very impulsively. The one thing I would like to mention before analyzing the liquidity of the least resistance, or to be more precise, the absence of such liquidity and any resistance in some interval of the chart, and most likely the price will break it very impulsively, is the effective and ineffective movement. In order to understand the liquidity of the least resistance, you need to understand the difference between an effective and ineffective movement. An ineffective movement is a price impulse, visually on the graph, forming an FVG, volume imbalance, or gap. This is caused by the imbalance of sellers and buyers, lack of liquidity on one of the sides. When the price returns to the imbalance zone, it becomes balanced. That is, this section of the price is balanced, and this movement is already called effective. That is, this impulsive movement is ineffective. If the price returns and blocks this ineffectiveness, this range will already be effective. For example, an effective movement with the presence of an FVG, that is, signs of an ineffective movement. Nevertheless, these zones of ineffectiveness were blocked, and accordingly, we see that this downward movement is effective. What is the point? The point is that this ineffective movement is both a magnet for the price, that is, the price will come to block this ineffectiveness, but it is also an area of resistance for the price. That is, the price most likely will have a hard time going in the direction of an ineffective movement, while an effective movement, when turning the trend, will break through very impulsively. And this type of liquidity is called low-resistance liquidity run. Low-resistance liquidity run is a type of liquidity expressed in its absence due to the effectiveness of the movement against the main trend. Usually breaks through impulsively due to the absence of a resistance zone for the price. That is, pay attention here. That is, we have some very effective movement, and any formation of ineffectiveness it breaks through, and accordingly, this movement is a downward trend. But after the price has come to a certain zone, and in this certain zone it began to unroll, as we saw here, that is, we have low, high, lower low, higher high. That is, we have formed some kind of a boss. We came to an FVG zone of ineffectiveness, the price consolidated, rolled back to the breaker zone, and after that it showed an impulsive movement with the LRLR removal. Why? Because this zone has no resistance. And why does it not have resistance? Due to the effective movement. That is, there is no longer any ineffectiveness here. No FVG, no volume imbalances, and so on. That is, this movement is effective. Naturally, this is from the point of view of liquidity, from the point of view of some other theories, and it is explained by the fact that this effective movement says that there is no such effective movement. When the price tests the zone, let's say the offer in this case, then the resistance goes down. Liquidity goes down, goes down, goes down, goes down, and accordingly, in the very last area, it consolidates. And after this liquidity has been eaten, due to the lack of liquidity here, this zone breaks through very impulsively. That is, when we have an effective movement against the main trend, that is, we have a main upward trend, and after the price has formed some recurring effective movement, shows some reversal, then most likely this area will break through impulsively if it does not have a resistance zone. That is, all order blocks, all inefficient zones in the form of FVG, volume imbalances, were blocked here. Accordingly, after the reversal of the trend, this zone became a low-resistance liquidity run, and when trying to open a position in the long here, we will most likely get an impulsive take profit on the withdrawal of the final liquidity, BSL, buy-side liquidity. After that, as you can see, the price has consolidated a little and gone down again. What to do? Block this ineffective movement. I hope the difference between an effective and ineffective movement is clear. Now,